Hello everybody and welcome to Project Trade. This is the Price Structure Show and the topic is support and resistance. It's one of the most common and recognizable forms of price action analysis and arguably the most used tool in all of trading. Support and resistance is one of the first trading concepts that new traders are likely to be introduced to just by the nature of its prevalence in the markets. Looking for support and resistance is looking at how the markets have previously responded to a given price level. They're areas where the price is seen as more likely to reverse its direction, usually because it's already reversed at that same level. An area with a higher frequency of reversals or more recent reversals can, broadly speaking, be seen as a stronger level. On its own, support refers to a price level where selling momentum tends to cease and buying pressure takes over. Price therefore often bounces up from the support level. Here's an example of a clear support area where price has U-turned off of it multiple times before finally breaking underneath that level over on the far right. Of course, in our cherry-picked example, we can get pretty close to showing support and resistance as true exact levels, but they are considered more generally to be zones or areas. If we are being really real about it, price is very unlikely to perfectly bounce off of the exact same pipette every single time. Be a lot cooler if it did. And when we're talking resistance, that is the opposite of support. So it's an area where buyers are seen as more likely to leave the market, or also where sellers are more likely to enter. This shifts the balance and therefore price can bounce off of the resistance level and reverse downtown southbound, which is what happened here. Twice there in the middle, price has a run up and tries to breach through the previously established range, but fails to do so, and after the second time it drops off into a downtrend. Again, these peaks aren't identical in their price, but they form a noticeable zone of resistance to a higher price level. Another common feature of support and resistance levels is that when a support area is breached, it can sometimes then become the new resistance level, and vice versa. If a resistance level is breached, then it could become the new support level. So with our chart on screen, we can see in this range up here on the left, price bounces off of the support level at around these points here. Then eventually it does have a breakout through the support level and it ranges before here over on the right, it bounces off of that support level, this time treating it as a new resistance level. Moving forward, let's remember that not all support and resistance levels are equal. It's much more of a scale where there are stronger and weaker levels. Unsurprisingly, it's the stronger ones that you should be trying to focus on more, as they can be considered the most likely to hold up and reverse from. They're the ones with those multi-hit reversals in a tight area, especially if they've happened in the recent past. They're the ones where you look at the chart and you just know, you can tell, you see it there, it is support and resistance at first sight, and it is a kind of magic. Because there are a lot of levels out there which are just weak, or worse even, coincidental. I mean, believe it or not, on occasion some investors and traders do make a trade without first checking they're exactly on the support or resistance level. Oftentimes for market reasons, the price is going to shift because buyers or sellers have just happened to step into the market at that point. I mean, if you sit there on your little chart and you go through all the time frames and on each one you mark out every potential support and resistance level, then you are going to find it wild when you zoom out and see how many levels that you actually set up. So if you are using support and resistance, then it is recommended for you to first zoom out on your time frame, get on the daily or the weekly to give yourself a clearer picture of the key areas and their relative strength. You're not going to be able to rely on every single level on the 1 minute time frame to put in overtime for you and stack your cash. Getting that more bird's eye style view sets a higher standard for what you're going to see as being a valid level. It's also worth mentioning that yes, there are certainly elements of market psychology at play with support and resistance, and sure, we can throw out that overused cliche of non-wisdom, non-advice to say that certain levels are made and endured by, wait for it, a self-fulfilling prophecy. But the sad fact is there's plenty of times where support and resistance just doesn't hold up and that sacred prophecy will not be fulfilled. And even on the strongest level, that prophecy still requires your subjective interpretation of exactly where you're going to enter. It's not one of those definitive prophecies, you know. So using these standard support and resistance concepts that we've been discussing, there are then two main signals that we can take to enter trades. Firstly, we can enter off that bounce and hope to see the prophecy fulfilled. It's all about a reversal in price with this one. So if price starts to bounce off of our resistance level and begins to head downward, then we could consider at that point entering a sell trade, and vice versa. If price bounces up from our support level, then it could be time to ride the bicycle. You could also have rules for entry criteria criteria regarding the strength of the levels. So you could say that you require price to have bounced off of that level at least X amount of times for you to trust the integrity of that level as support or resistance. Here's a resistance example, that level marked there with the white line. On the left we see the first test of the level. At the bounce you'd be fair to think that, well, a lot of green candles came in the run up to that bounce, so we haven't seen it at that level before. It could just be a price retracement rather than actual resistance level. Then price tests it again, they're just probing through for the high of that candle before snapping back down. Now your confidence grows in that level as a resistance level, and you say to yourself, okay, it's bounced from there twice. If it does it a third time, I am going to trust it. Price then ranges and trends down slowly for a while before it snaps back up on the right and hits that resistance again. At this stage, based off that previous action, you are fully expecting the sellers to retake control, and when those red candles start to come, that's your moment. You are in, and we do see price take a steep fall, so hopefully you took some profits there at some point. Of course, it is super easy for me to sit here and say all this with hindsight and a perfectly healthy voice box, but in real world trading, it's not always going to work out as well as our special purpose chart here. As we've touched on already, there can be a large amount of subjectivity in determining support and resistance levels. Timing your reversal trades isn't always going to work out. It's trickier than something like a zero line crossover technical indicator where the signal is dished up clear for you. You've got to be prepared financially and psychologically for the times you personally are wrong. Moving now to our second potential entry signal, instead of trying to catch the reversals, we can wait for price to break through the level and then make our trade in the same direction as the breakout, trading it as if it were a blossoming trend. So if price breaks through a resistance level, then you'd enter a buy trade, and if it breaks through a support level, then you'd enter a sell trade. Here's an example of price breaking through support. We see how it probes through the support zone with lows in these areas here. These are ones you've got to watch out for, by the way, fake outs rather than breakouts. They probe through, but you don't get a solid close of price past the level, so the move never really has full credibility. Even one candle just about closing through doesn't necessarily mean the breach has occurred. It's down to that subjectivity again. And the real breakthrough eventually comes over here when we see this large red candle closing below support. It then goes on to take a real tumble downwards. If you didn't manage to take profits on this one after entering there, then I don't know what to tell you. In flowery language, you were an adventurous, optimistic entrepreneur, and in damning language, you were a greedy, narcissistic, devolved being. Me, I'm somewhere in the middle, because who likes such extremes? Those are the two big entry signals, the bounce and the breakthrough. But is it possible support and resistance could also help our money management? One trick that we can employ and deploy is that if there's a breach of support or resistance in the direction against our trend, then we would take that as the signal to close our trade. So say for example we were in a buy trade, we would set our stop loss just below a support level. Of course this can play into those fake outs that we just talked about too. It could be that price was only probing through the support and it actually then reverses back in your trade's favor. However, your stop loss already triggered from the probe. Be prepared for that type of price action if you are using this method for your stop loss. It'll probably catch you out sooner or later. We could also set our take profit at the support or resistance level. Don't wait to discover if there's a breakout or a fake out. When it touches your level, you take that profit. So imagine we're in a buy trade and the price comes to a strong resistance area. That is all we need to know to take profit. Then we can see what price does next. We might even get a re-entry signal. Depends on the strategy. You could also utilize support and resistance levels as a type of trailing stop loss. So if you're in a trend trade which is breaking through a level and then consolidating, breaking through another level, consolidating again, you could keep your stop loss one level previous to where the price is at. So you're in a sell trade and price breaks down through support level 1 to support level 2, you set your stop loss a smidge above support level 1. If price continues to breach support level 3, then you would move your stop loss slightly above level 2, and so on and so forth. Can be a good way to try and stretch out those profits if the trend is willing to keep on giving to the good, or just ways to try and help minimize your risk and maximize those gains. At the end of the day though, if your visceral instinct is to just go all in without any particular reason other than your gut instinct, then well, at least it's entertaining if not financially irresponsible. In the markets, support and resistance is used absolutely everywhere. You are going to find traders using this on forex, stocks, energies, crypto, coffee, wheat. It is rampant across asset classes, that is for sure. And something we mentioned earlier that does bear repeating is that the higher time frames are almost always always going to be more reliable for support and resistance because you're going to see those stronger, more well-tested levels. On something like the 1 minute or 5 minute time frame, you could be certain that something is a support level, zoom out, and it's only the second time that price has ever reversed there. Whereas just a little ways on, there may be a level where price has bounced off 6 or 7 times. It can be a good way to get annoyed at yourself for not being patient and waiting for the more reliable signal. In conclusion, support and resistance levels are a key tool to be able to clip onto the tool suspenders that are price structure. We have covered what can be considered to the absolute bare minimum basics here, but we now know the essence of support and resistance is that they are price zones where price is more likely to retrace or reverse because that's what it has done in the past. Spotting these areas can be a bit more of an art than a science, as not everyone will always agree on which levels they see as being support or resistance. The main entry signals from support and resistance are based on whether price reverses there or breaks through. The reversal theory is probably the more renowned of the two, but if you are trying to trade breakouts, then watch out for those fake outs. Don't let them get you down. And if you do want to use the levels for take profit or stop loss, then you've got that option too. Just don't try and be overly generous. Don't let it breach level after level against you just because of some rule that you have that says that you always close the trade after it breaks through something like the 40-second level. At that stage, your broker has probably closed it out for you. But this all helps show the versatility and diversity in uses for support and resistance. Even at its basic level, it is a great assistant for analyzing simple market structure, and that is without getting into anything like Fibonacci, dynamic support and resistance, wedge patterns. It goes on and on, but not for us, because that is it for support and resistance in this video. But there is of course a bit more information in the description. One last warning that I did pre-select all of these charts. They are not by random. I did not just happen to step onto a chart and find these fantastic, perfect examples of support and resistance. Sorry to say it, the fix is in for these charts, but we have tested support and resistance in live forward testing strategies with real demo money, and so those will also be linked in the video description. This is Project Trade. I am the Minister of Trade. Thank you for watching or listening.